Hi, and welcome back to the Beyond Accountancy YouTube channel. The Australian tax system allows you to structure your investments to achieve a low tax or even a tax-free retirement, but you need to know how the system works so you can take advantage of these benefits. Now, tax structuring is only part of the process of retirement planning. The three most important parts of a retirement plan to me are working out what your retirement lifestyle will look like and what it will cost, choosing the right tax structure for your investments, and then choosing the right investments. All three are related, but this video is about the second step. So firstly, you'd work out what you want to spend in retirement, and then simply you just need to find a retirement income to match those expenses. That's retirement planning in a nutshell. But that income can come from various places. Could be superannuation, investments you hold in your own name, or even the age pension if you're eligible. Now, depending which of these you choose, you can have a higher tax or a lower tax retirement. It's easier to balance the scales of income and expenses if the tax office is not taking more than they should be. If you have to budget for tax and expenses, you need more income. Or to put it another way, the more they take in tax, the less you get to enjoy. Let's put some numbers on that. If you earn an $80,000 gross pre-tax income and you have to pay tax on it, that's only $63,600 in your pocket. But if you earn that money tax-free, you get to enjoy the full 80,000. That's $16,000 better off compared to a retiree who hasn't worked with the system. So here are three ways to enjoy a tax-free retirement in Australia. Firstly, you can earn some tax-free income on the investments you hold in your own name. These are the tax rates that Australia has just announced for the 2025 financial year. So these commenced in July 2024. You'll notice that the first category is tax-free. We call it a tax-free threshold. As well as the tax-free threshold, there's a $700 low-income tax offset. So if you're a low-income earner, you get a credit to cover tax of $700, and that covers the tax on about $4,000 of your income. So the effective tax-free threshold was actually more than $22,000. And again, some retirees are entitled to an additional seniors and pensioners tax offset, which makes the effective threshold even higher. Now, not everyone will get this, but we can say that you can earn at least $22,000 as a low-income earner if you retire in Australia. So that's a good place to start in terms of a tax-free retirement. There's also tax-free foreign income, which is applicable to some retirees who are not originally from Australia. If you meet the definition of a temporary resident for tax purposes, you're not liable for tax on your foreign income from non-employment services. That includes interest, dividends, royalties, rent, and overseas pensions. Basically, if you're not from Australia originally and you're not yet on a permanent visa, and neither is your spouse, then most of your foreign income will be tax-free, everything but the work income. This is particularly important if you're from Middle Earth or New Zealand, as it's also called, because you can be on a temporary resident visa for an extended period, possibly forever, whereas other nationalities don't have that benefit. And the third part is the centerpiece of a tax-free Australian retirement, and that's superannuation. I've already talked about how your personal income could be tax-free, but could also be taxable. But there's also tax-free and taxable super. Your superannuation account starts off in accumulation phase. In this phase, you pay 15% tax on the money your super fund earns, for example, interest or dividends. But if you switch your account to retirement phase, the tax on your earnings becomes zero. So what's an obvious way to get a lower tax rate in retirement? Switch your superannuation account from accumulation to retirement phase. Now, you need to take a minimum pension each year once you're in retirement phase to qualify for the 0% tax, and that minimum percentage starts at 4% and rises with age. But you'll essentially drop your tax from 15 to nil. Then, if your personal investments are causing you to pay personal income tax, you can move some of your investments into super, and again, bringing your tax rate down to zero. But what I probably wouldn't do would be to move assets from my personal name into super if I'm already paying 0% tax on those assets. Why switch tax structures and move into the slightly more complicated superannuation system if you've already got the benefit of the 0% tax rate? Super is about tax savings. If you already have those tax savings, you can actually overdo super. What about if you're not yet retired and you've still got a couple of years of work to go? Well, the main way you can improve your tax structuring in pre-retirement years is to make extra superannuation contributions. You can boost your retirement assets by making extra super contributions, and the reason you do that is that it reduces your rate of tax depending on your tax bracket. So here's a table of the different tax brackets. You'll notice that in the first two, super is not better. In fact, in one of them is worse than personal tax. But in these four brackets, you can see that there's a tax saving because of the difference between the tax rate in super and the tax rate on personal income. Let's flesh that out with an example. So again, somebody earning $80,000 of gross income per year, and we noted previously that they pay $16,000 in tax. If instead of taking $80,000 as salary, $60,000 as salary, and $20,000 as extra super contributions, you'll drop that tax down to less than $13,000. You notice that the green color there is also smaller. So it means you've got less take-home pay for this period, but you're essentially giving up some income now to get even more than that in retirement. As I mentioned earlier, investing money is the last step in the retirement planning process and an important step. And you can invest in all sorts of different things. Like there's some examples of some asset classes there on the screen. But in terms of ensuring a tax-free retirement, it doesn't actually matter what you invest in. It's about having those investments in the right tax structure. And any of those different investment types can be held in any of the structures. So what can you do to take action and ensure that you're working within the rules so that you're getting the tax-free retirement that the system intends you to have? Well, you can seek advice from an accountant. So as accountants, we can apply these principles to your situation, not just to the generic examples in these slides. We can help you avoid paying too much tax leading up to retirement and avoid paying too much tax in retirement. You can book a tax advice meeting on our website. You might also want to see a financial planner. So as an accountant, I can explain tax strategies and how you could structure your assets to avoid overpaying tax and a lot of the topics in here. But I can't actually make recommendations. So I can't say you should add $20,000 to super. I could say, here's what would happen if you did, but I can't actually recommend it. I can't choose investments. I can't tell you to open a new super fund or close a super fund or anything like that. So financial planners can make those specific recommendations. But not only that, the reason most people use them is to actually get those things done for them to implement the plan. If you book an advice appointment, we have a financial planning firm that we work with, and they're happy to have one of their advisors join the call for no additional charge. So I hope you found that helpful, and I hope you learned something new about retiring in Australia. Thanks for watching, and we'll see you next time.